Dayon after this class. Got it?
Oh, thank you.
Okay. Yeah, okay. So what we have discussed up till now, let me share you the blackboard here, whiteboard here. Balance of payment. It has two accounts, current account and capital account. And then current account is divided into three. Number one, balance of trade, right? Which we just learned in our video. Okay, so don't get confused what's going on here. Okay, here we go. So now the balance of trade, also called the payments for merchandise and service account, right? Which we just learned in our previous video. So merchandise exports and imports represent tangible products that are transported between countries. Service import and exports is basically represented through tourism and other services like banking services. One country is giving banking services to other, right? Tourism, of course, other people, other nationals, they are coming to the country and visiting the company, paying taxes, paying for the visas. These are all services payment. So all the amount of these transactions, these international transactions, gonna be recorded in current account under balance of trade or payment for merchandise and service account. So right now, what we are dealing with, country finances, not the company. We talk about international financial environment with respect to MNC, right? But right now, what we are talking about, how countries interact with each other. So you need to be very, very careful here. How countries, they are connected with each another. Okay. Okay. And now the second one is factor of income payments. So it represents all the interest and dividend payment received by investor on foreign investment in financial asset. If I have invested in China, in Chinese companies, or as a form of shares or as a form of bonds, I receive dividend or any interest payments. So all those income is going to be included in countries current account under factor income payments. And the last one is transfer payment. Any any aid, any help in the form of money, right, gift that one country send to another country. Like I told you, just the great flood hit Pakistan, so we received a lot of aid, financial aid from China, from America, from UN, right? So all those payments are going to be recorded in current account under transfer payments, right? Okay, let's take 10 minutes break and then we start again from here. Okay, class, welcome back after the short break. Okay, we were discussing regarding the balance of payment. And in this balance of payment, we talk about there is one current account and there is capital account. So we have just discussed the elements of or the number of accounts that are included in current account. Number one, balance of trade or payment for merchandise and services. Number two, factor income and factor income payments. And number three, transfer payments, right? let's talk about its example. So examples of current account transactions. Remember we talked about this is country to country, right? So number one is international trade transactions, which is the JC Penney purchases stereo produced in Indonesia that it will sell in its US retail store. So what will happen? This JC Penney, it purchased the stereo produced in Indonesia, and they will sell it in our in the US retail store. So remember, this book is US centric. So even if I'm sending you the books chapters and all the stuff, so this book is US centric. If question is silent, automatically assume so yourself that you are in the US. And when you are in the US, you are importing from Indonesia. So it means your home is US and the foreign country is Indonesia. So this JC Penney is basically the US company who imports or who purchase or whose company is in the Indonesia that produces the stereo system, and they are sending it to you. You import it and you sell it in US market. So in this case, US outflow, which means the dollar will go out, right? So this is basically cash outflow from the US. You understand? Because we are importing. When we import, goods will come to the country. This is Indonesia. So they will sell you stereo and you will give them money. So in this case, right now, what we are talking about, we're just talking about the cash flow positions. Let me change the color. So we're just talking about what is the position of cash flow, whether it is cash outflow, which is going out from the country, or cash inflow, which is cash coming to the country. So when we buy goods from Indonesia, we are importing. Goods coming to the country and money going out, cash outflow. Similarly, the number second, individuals in United States purchase CDs over the internet from a firm based in China. In US, CDs are coming and money is going out China. So in this case, this is cash outflow, right? So this is the accounting stuff. If you already go through the accounting, or you will remember that, or you try to understand that when money is going out from the business, but you pay cash, your expense increases, if you want to purchase something, so those are debited. So we'll talk about don't worry if you don't understand that one, we'll talk about in accounting. Number three, the Mexican government pays a US consulting firm for consulting services provided by the firm. The Mexican government is paying US. Let me clear this stuff here. Can I clear? The Mexican government is paying US. Paying, which means they are paying money for their, and US provided them services. So money is coming in the US. That's why it is called inflow. Cash inflow. Similarly, the IBM headquarters in United States purchases computer chips from Singapore. They purchase from Singapore. Chips are coming to US and money is going to the Singapore. So it is cash outflow. Any question? Tiffany, EGA,
I'm good.
Lancelot, Oliver. Good. So I'm going to read it a little bit faster. A university bookstore in Ireland purchases textbooks produced by a US publishing company. So US publishing company, you are in US. So that's more tricky one. You are in US, and from you, a university bookstore in Ireland, they purchases from you. You provide books to Ireland, and Ireland give you money. So this is cash inflow. So here, US cash inflow, right? For Ireland, this is outflow. Ireland will pay the money and receive the books. US will receive the book and sell the books, right? Similarly, with the international income transactions, previously these were trade transactions, import and export, and now the income transactions. So if you're able to understand the inflow, outflow, then the next, the lecture is going to be very easy for you when we talk about what happened to the dollar, what happened to the euro and all those stuff. So it will be more easy for you. A US investor receives a dividend payment from a French firm in which she purchased stock. A US investor, you are in US, you invested in French company. Now what happened? You receive money, right? The French company gave you the stock and received the money from you, but this transaction is you receive dividend payments, right? Company give you the money, so that's why this is inflow. Cash is coming to the US. Number two, the US Treasury sends an interest payment to German insurance company that purchase US Treasury bond for 1 year. Similarly, US government is paying interest, outflow. Cash is going out from the country. So whenever you read the questions, mark yourself where you are. Are you in US or are you in Germany? If you are in US, then for US perspective, it is outflow, right? So this is a trick that I always do that. I always mark this signature and that I am here and I am where, US or in Germany, then I decide accordingly whether this is inflow or whether this is outflow. The third one is Mexican company that borrowed dollars from bank based in United States sends interest payment to that bank. No, this is basically history that they borrowed dollars from the US, and now at this moment, what happened? The Mexican company sends interest to the US bank. US bank will receive the money. It means this is cash inflow with respect to US.